CFA Level 1 Practice Questions. Learning Module, Monetary Policy. Topic, Role of Central Banks. A country's central bank announces that it will prioritize maintaining an annual inflation rate near 2%, even if this requires tightening policy, despite slowing economic growth. This policy stance most clearly reflects the central bank's focus on stimulating short-term economic growth to reduce unemployment. B. Maintaining price stability to preserve purchasing power and confidence. C. Keeping long-term interest rates low to support government borrowing. The neutral real interest rate for an economy is best defined as the rate that temporarily boosts short-term growth without affecting long-term inflation. B. Aligns with the economy's long-term growth potential while maintaining price stability. C. Reflects only short-term fluctuations in demand and supply, ignoring long-run trends. The central bank's priority is price stability. Even when growth slows, it tightens policy to keep inflation near 2%, showing that preserving purchasing power and confidence outweighs short-term growth concerns. A. Wrong because stimulating growth would require easing, not tightening. C. Wrong because tightening raises interest rates, which makes government borrowing harder. Supporting fiscal needs is not the central bank's independent mandate. The neutral real interest rate is a long-run equilibrium benchmark. It balances aggregate demand and supply at full employment, ensuring price stability, while aligning with the economy's sustainable growth potential. A. Misleads by focusing on temporary short-term growth boosts. That describes rates below R, not the neutral rate itself. C. Misstates R as reflecting short-term shocks, when in reality it is anchored in structural, long-term factors like productivity and demographics. Topic, Monetary Policy Tools and Monetary Transmission. When a central bank aims to lower the rate of inflation in the economy, which type of interest rate policy is it most likely to adopt? A. Expansionary. B. Neutral. C. Contractionary. When a central bank announces an increase in its policy rate, the immediate effect is most likely a decrease in business borrowing and investment. B. Increase in household consumption and credit demand. C. Depreciation of the domestic currency. A central bank is concerned that economic growth is slowing and inflation is below target. Which of the following policy actions is most consistent with stimulating investment and consumption without directly targeting the exchange rate? A. Increasing reserve requirements for commercial banks. B. Initiating open market purchases of government securities. C. Announcing a higher policy interest rate to attract foreign capital. An economy has a long-run inflation target of 2% and an estimated real neutral rate of interest of 0.5%. The central bank, which has high credibility, has set its policy rate at 2.0%. According to standard monetary theory, which of the following scenarios is the most likely outcome of this policy setting? The money supply will contract, leading to higher market interest rates and a slowdown in economic growth. B. The policy stance is neutral, and the economy is likely to maintain stable growth with inflation consistent with its target. C. Long-term inflation expectations will become unanchored due to the persistently accommodative policy stance. A financial analyst states that a central bank is concerned about rising asset bubbles and high inflation. To address these concerns, the analyst claims the bank will lower its policy rate and instruct the Treasury to initiate a new corporate bond purchasing program. This proposed policy approach is A. Correct, as lowering the policy rate is a standard tool to cool down an overheated economy. B. Incorrect, because the policy mix described is contradictory to the stated economic goals. C. Correct, because purchasing corporate bonds will reduce liquidity and stabilize prices. A central bank is concerned that inflation is rising above its target and that financial institutions are taking on excessive risk. To address these concerns, the central bank raises its policy rate and begins selling long-term government bonds from its portfolio. The most direct and immediate result of these combined actions will be A. An increase in bank reserves, a steepening of the yield curve, and higher long-term capital investment. B. A reduction in bank reserves, a rise in short-term and long-term interest rates, and tighter credit conditions. C. A depreciation of the domestic currency, which will boost exports and offset the restrictive policy impact. When a central bank raises its policy rate to combat high inflation, the primary long-term effect of this action is most likely to be a sustained increase in long-term bond yields, B. A reduction in aggregate demand, leading to lower inflation, C. An immediate decline in consumer spending but no change in inflation. A central bank regularly publishes detailed minutes of its policy meetings, explains its inflation forecasts, and provides forward guidance on future interest rate decisions. These practices most directly enhance the central banks. A. Independence from political interference. B. Transparency in monetary policy communication. C. Ability to directly control inflation outcomes. Lowering inflation requires a contractionary policy, raising interest rates to reduce borrowing, spending, and aggregate demand. This cooling effect slows growth and eases inflationary pressures. Expansionary would lower rates, stimulate demand, and actually increase inflation, the opposite of the goal. B. Neutral keeps rates unchanged, which fails to actively reduce inflation in a high inflation environment. Raising the policy rate makes borrowing more expensive, so business borrowing and investment decrease immediately. This is the central bank's intended tightening effect to slow activity and inflation. B. Wrong because higher rates discourage household borrowing and consumption, not increase them. C. Wrong because higher rates attract foreign capital, leading to currency appreciation, not depreciation. Policy rate increases, market interest rates increases, borrowing costs increases, business investment decreases, household consumption decreases, and domestic currency appreciates. Open market purchases inject liquidity, lower interest rates, and stimulate investment in consumption, which directly addresses slowing growth and below target inflation. The focus is on domestic demand, not exchange rate targeting. A. Raising reserve requirements reduces lending and tightens credit, which slows growth further, the opposite of the goal. C. Raising policy rates discourages investment in consumption, while directly targeting foreign capital inflows and the exchange rate, which contradicts the question's condition. Open market purchases, which results in money supply increases, interest rates decreases, borrowing increases, investment and consumption increases, growth increases, inflation closer to target. The neutral nominal rate equals real neutral 0.5% plus inflation target 2% equals 2.5%. The policy rate at 2.0% is only slightly below neutral. So with strong credibility, inflation expectations stay anchored at 2%. This stance is effectively neutral, supporting stable growth and target inflation. A. Contraction requires rates above neutral, but here the rate is below neutral, so no slowdown. C. Unanchored expectations occur only if credibility is lost or policy is persistently accommodative. With credibility intact and only a small deviation, expectations remain stable. The economy is overheated, high inflation, asset bubbles, so the correct response is contractionary policy, raising rates and reducing liquidity. The analyst's proposal of lowering rates and buying bonds is contradictory. Lowering the policy rate and purchasing corporate bonds are both expansionary actions. They increase liquidity, borrowing, and asset prices, which would worsen inflation and bubbles. Also, bond purchases are a central bank function, not the Treasury's role. A. Wrong because lowering rates stimulates demand instead of cooling it. C. Wrong because bond purchases add liquidity, fueling inflation and bubbles, not stabilizing them. Raising the policy rate and selling long-term bonds both withdraw liquidity. This reduces bank reserves, raises short and long-term interest rates, and tightens credit conditions, directly addressing inflation and excessive risk-taking. A. Wrong because selling bonds reduces, not increases, reserves and higher rates discourage investment rather than boost it. C. Wrong because higher rates attract foreign capital, leading to currency appreciation, not depreciation. Currency effects are secondary, not the immediate outcome. Raising the policy rate combats inflation by reducing aggregate demand. Higher borrowing costs slow consumption and investment, and over time, 6 to 24 months, this leads to lower inflation, which is the central bank's long-term goal. A. Long-term bond yields may rise initially, but they are not the primary long-term effect. The focus is inflation. C. Spending does not decline immediately, and inflation does change over time. Assuming no inflation impact contradicts the rationale for rate hikes. Publishing minutes, explaining forecasts, and giving forward guidance are all about clear communication. These practices enhance transparency, helping markets and the public understand policy decisions, reducing uncertainty and improving policy effectiveness. Independence is about structural autonomy from political influence, not communication. Transparency supports accountability but does not guarantee independence. Central banks cannot directly control inflation because external factors matter. Transparency shapes expectations but does not mechanically determine inflation outcomes. Topic: Monetary policy objectives. When an economy remains stuck in a low-growth equilibrium, despite the central bank maintaining near zero interest rates for an extended period, the situation most likely indicates the central bank should immediately raise interest rates to stimulate demand. Traditional monetary policy tools have become less effective in boosting economic activity. C. Fiscal policy. Government spending is no longer needed to support growth. Which of the following scenarios is most consistent with a central bank pursuing expansionary monetary policy? Raising the policy rate to curb inflation expectations. B. Selling government bonds to reduce bank reserves. C. Lowering reserve requirements to stimulate credit growth. Which of the following is a key reason why central banks struggle to revive economic growth during a severe deflationary spiral? A. Households increase savings in anticipation of future tax hikes, Ricardian equivalents. B. Fiscal policy becomes more effective than monetary policy at stimulating demand. C. Nominal interest rates cannot be reduced much below zero, limiting rate cuts as a stimulus tool. A country maintains a fixed exchange rate pegged to the US dollar. The country's inflation rate rises persistently above the level of inflation in the United States, leading to a growing current account deficit. To maintain the fixed exchange rate, the country's central bank must intervene in the foreign exchange market. The most immediate and direct consequence of this intervention is an automatic decrease in the domestic money supply that helps to correct the inflation differential. B. Increase in the central bank's foreign exchange reserves. C. Decrease in the central bank's foreign exchange reserves. A central bank lowers its policy rate to stimulate economic growth. but inflation continues to fall and credit growth remains weak. Which of the following best explains this contradiction? A. Lower interest rates reduce the cost of borrowing, encouraging investment and spending. B. Commercial banks may be unwilling to lend despite increased liquidity. C. Lower interest rates increase asset prices, boosting consumer wealth and demand. An economic commentator argues, the central bank's recent decision to lower its policy rate is ultimately futile. While it may temporarily lower market interest rates, it cannot create real, sustainable growth. In the long run, this action will only lead to a proportional increase in the overall price level, leaving real output unemployment unchanged. This commentator's view is most directly aligned with the concept of A. The monetary transmission mechanism. B. Money neutrality. C. Expansionary monetary policy. Near zero interest rates with stagnant growth signal a liquidity trap, where traditional monetary tools, rate cuts, lose effectiveness. This shows monetary policy alone cannot boost activity, and alternative measures are needed. A. Raising rates would be contractionary, worsening low growth. C. Fiscal policy is still essential in a liquidity trap, since monetary policy is ineffective. Saying it's no longer needed contradicts standard theory. Lowering reserve requirements is an expansionary tool. It allows banks to lend more, increases credit growth, and stimulates investment and consumption. Exactly what expansionary policy aims to achieve. A. Raising the policy rate is contractionary, used to curb inflation, not stimulate growth. B. Selling government bonds drains reserves and tightens credit, also contractionary, the opposite of expansionary. In a deflationary spiral, nominal interest rates are already near zero, so further cuts are limited. Real interest rates remain high because deflation raises the real cost of borrowing, making traditional monetary policy ineffective. A. Ricardian equivalence affects fiscal policy, not the central bank's ability to cut rates. B. Fiscal policy may be more effective in this situation, but the question asks specifically about the constraint on monetary policy, which is the zero lower bound. With higher domestic inflation and a current account deficit, demand for USD rises, putting depreciation pressure on the local currency. To defend the peg, the central bank must sell USD reserves and buy local currency, which directly causes a decrease in foreign exchange reserves. A. A decrease in the money supply can occur as a secondary effect, but the immediate and direct result is reserve depletion. B. Reserves increase only when the central bank is buying USD during appreciation pressure, but here it is selling USD to defend against depreciation. Even with lower policy rates, banks may be unwilling to lend due to risk aversion, weak borrower demand, or deflationary expectations. This breaks the transmission of monetary policy, leaving credit growth weak and inflation falling. A. Describes the intended effect of lower rates, stimulating borrowing and spending, but does not explain why it fails here. C. Refers to the wealth effect, higher asset prices boosting demand, but again assumes the mechanism is working, which contradicts the observed weak credit growth and falling inflation. The commentator's view reflects money neutrality. Monetary policy can affect nominal variables, prices, wages, in the short run, but in the long run it has no lasting impact on real variables like output or employment. The only enduring effect is a higher price level. A. The monetary transmission mechanism explains how policy affects the economy in the short run, but the commentator is focused on the long-run limits of monetary policy. C. Expansionary monetary policy refers to the act of lowering rates or adding liquidity, but the commentator is critiquing its effectiveness, not defining it. Topic: Interaction of monetary and fiscal policy. A government announces a major fiscal stimulus plan involving increased public infrastructure spending, while the central bank simultaneously raises its policy rate to control rising inflation expectations. Assuming wages and prices are rigid in the short run, which of the following is the most likely outcome? Private investment expands, increasing the private sector's share of GDP. B. Government spending as a share of GDP rises as private sector activity slows. C. Both public and private spending increase equally, leaving GDP composition unchanged. In which of the following economic conditions is quantitative easing, QE, most likely to succeed in stimulating economic growth? A. Period of high inflation and rising interest rates. B. A liquidity trap where short-term interest rates are near zero and banks hoard reserves. C. A credit crunch caused by declining bank reserves but with positive interest rates. A government implements a significant reduction in public infrastructure spending to control its budget deficit, while the central bank simultaneously lowers policy interest rates to encourage lending. Assuming inflation remains stable, which of the following outcomes is most likely? A contraction in private investment due to tighter credit conditions. B. An expansion in private sector activity as borrowing and investment become more attractive. C. Rise in government spending as monetary easing offsets fiscal tightening. Following a period of weak credit growth and declining inflation, a central bank begins purchasing large quantities of long-term government bonds in the secondary market. Which of the following outcomes is most consistent with the intended effect of this policy? A. An increase in commercial bank reserves and lower long-term interest rates. B. A decrease in commercial bank lending and higher borrowing costs for firms. C. A reduction in liquidity and appreciation of the domestic currency. A central bank begins large-scale purchases of long-term government bonds in response to persistent low inflation and weak economic growth. Which of the following outcomes is most consistent with the intended effect of this policy? A. Lower long-term interest rates and increased credit availability in the economy. B. Higher borrowing costs for businesses and a reduction in money supply. C. Currency appreciation driven by rising domestic interest rates. A government is designing a fiscal stimulus package of $100 billion to maximize the immediate boost to gross domestic product, GDP. The package must be allocated to a single one of the following options. Which option will most likely achieve this goal? One-time cash transfer of $1,000 to every household in the country. B. A tax rebate of $1,000 provided exclusively to households with below-average incomes. C. Direct government investment of $100 billion in national infrastructure projects, such as building bridges and expanding broadband internet access. Fiscal stimulus raises government spending, G, while monetary tightening raises borrowing costs, reducing private investment, I, and consumption, C. With wages and prices rigid, the immediate effect is a shift in GDP composition toward government spending as private activity slows. A. Higher interest rates discourage, not expand, private investment. C. Public and private spending do not rise equally. Fiscal expansion boosts G, but monetary tightening suppresses C and I, so GDP composition changes. QE is most effective in a liquidity trap, when short-term rates are near zero and traditional rate cuts no longer stimulate growth. By buying long-term securities, QE lowers long-term borrowing costs and injects liquidity, encouraging lending and investment. QE works by pushing investors toward riskier assets, boosting wealth effects and easing financial conditions. Historical examples post-2008 crisis, Eurozone debt crisis show Q's success in liquidity traps, where conventional tools fail. A. QE is expansionary, so using it during high inflation would worsen overheating instead of cooling it. C. With positive interest rates, conventional tools, rate cuts, open market operations are still effective, so QE is unnecessary. Fiscal tightening reduces government spending, while monetary easing lowers interest rates and borrowing costs. This combination shifts resources toward the private sector, encouraging investment in consumption. With stable inflation, the result is a crowding in effect, where private activity expands as government spending falls. A. Lower rates ease credit conditions, so private investment expands rather than contracts. C. Government spending is explicitly reduced by fiscal policy. Monetary easing cannot directly raise it. Large-scale bond purchases, QE inject liquidity by crediting bank reserves, so commercial bank reserves rise. Increased demand for bonds pushes prices up and yields down, leading to lower long-term interest rates, which stimulates borrowing and investment. B. Describes contractionary effects, less lending, higher borrowing costs, which contradict Q's expansionary purpose. C. QE increases liquidity, not reduces it, and typically leads to currency depreciation, not appreciation. Bond purchases results in reserves up, interest rates down, borrowing up, investment or consumption up, growth and inflation up. Large-scale bond purchases are quantitative easing, QE, and expansionary policy. QE raises bond prices, lowers long-term yields, and injects liquidity by increasing commercial bank reserves, which makes borrowing cheaper and credit more available. B. Describes contractionary policy, bond sales, or rate hikes, which would raise borrowing costs and reduce money supply. Opposite of Q's purpose. C. QE lowers interest rates, which usually leads to currency depreciation, not appreciation. Infrastructure spending has the highest multiplier effect, 1.5 to 2.5, meaning each dollar spent generates more than a dollar of GDP. It directly counts as government spending, G in GDP, creates jobs, boosts demand for materials, and improves long-term efficiency. A. Universal cash transfers have a low multiplier, 0.5 to 1.0, because high-income households save more, so less of the money is spent immediately. B. Tax rebates to low-income households have a higher multiplier, 1.0 to 1.5, than universal transfers, but still rely on household spending decisions and may be partially saved, making them less immediate and impactful than infrastructure investment.